Welcome to the Motor Carriers Insurance Education Foundation's in-depth review of coverages addressing the unique operations of a motor carrier webinars. Today's subjects are auto liability symbols, and we're going to start with looking at the any auto symbol. Those webinars are not filed for state CE credit and are learning opportunities only. If you have any questions, please send an email to trs@mcief.org and we'll answer your question when we receive them. The auto liability insurance agreement reads as follows. We will pay all sums an insured legally must pay as damage because of bodily injury or property damage to which this insurance applies caused by an accident and resulting from the ownership, maintenance, or use of a covered auto. So when a crash happens and the insurance carriers get the report of the crash, the first thing they look at when the adjuster handles that claim is, did the crash happen by use of a covered auto? If it's not, then there's questions about are they coverage or not provided. Because so all responses by an insurance carrier on behalf of insured at a crash time was it a covered auto that caused the crash? So we're going to look at the covered auto symbols. So we're going to look at what's a covered auto. It starts with the numbers listed in item 2 of the deck. For the policy to respond, the accident must be caused by an auto that meets the definition of the symbols that defines a covered auto. And this is where we find this wording. Item 2, schedule of coverages and covered autos. This policy provides only those coverages where a charge is shown in the premium column below. Each of these coverages will apply only to those autos shown as covered autos. Autos are shown as covered autos for a particular coverage by entities of one or more of the symbols from the covered auto sections of the business auto motor carriage form or the business auto form or the motor carriage form. Same wording in either one. So these are the first 7 items that we have for liability purposes. And if you read the second item, the middle item there, coverage autos, entities of one or more symbols from the covered auto section of the motor carriers form or business auto form shows which autos are covered autos. So you add numbers there, and then with those numbers, obviously you put limits and they generate a premium. The number one focus here we would have is the first one, auto liability. Obviously, some states like Florida and others, Michigan, all you have some personal injuries and additional personal injuries. Some states have property protections as a part of Michigan only. Med pay, uninsured motorists or uninsured motorists are the other areas that deal directly with auto liability concerns. But the ones we're going to focus on here is this item 1, liability, and the symbols that trigger those. Policies will use numbers to tell what type of auto, as it relates to the insured, will require the policy to respond. These numbers will be shown in item 2 of the deck and documented. There has to be a number for all symbols needed, all coverage needed. The number symbols will have a meaning. It defines autos that are covered autos. The insured must have the correct symbols to have coverage as time of accident for each coverage they decide they need. Things unique to motor carriers, truckers, government regulation, financial responsibility imposed by the federal and state government. The insurance provider must meet these requirements. These are promised to protect the public, including both owned and non-owned autos, meaning any auto they uses as a part of their business as a motor carrier, the public will be protected with the financial responsibility requirements being met by the insurance carrier of that motor carrier. If no coverage, then still the insurance carrier still could be obligated to address damages to the public because of the 91 filing to the FMCSA, the MCS 9 endorsement because of the Motor Carriers Act of 80, or the state Form E filings. These financial requirements do not provide coverage to the insured, not even defense. but do obligate the insurance carrier to pay a judgment rendered against the insured. The financial responsibility obligation obligates the insurance carrier who provides the proof of protection to the public. If there is no coverage in policy, if the accident was caused by a commercial motor vehicle whose GVW is 10,000 GVW or larger, whether or not the vehicle is specifically described on the policy or not, will require the insurance carrier to respond to the final judgment. So that's the key part here. Anytime the insurance provider makes a filing, which they have to do to make the motor carrier legal so they can operate or save them a fine, what that financial responsibility pledges to the federal government or to the state government, that if the insured uses a vehicle that is not a covered auto, then the public will still be protected. Again, the insured gets no protection, but the public gets protection. Also, for premium consideration, all the premium is based on a auto, meaning they file it with the state, and the state rates are filed with the state. For admitted carriers, non-admitted carriers, don't have to be filed with the state, but basically all premiums are a function of the power unit and the trailer. So you get a dollar amount per power unit per trailer. All those power units or trailers, all the ones that are used by the motor carrier have to be considered, because of the previous slide, the insurance company is responsible for paying damage done by any auto the insured uses, whether owned or not owned, as long as it's being operated as a part of their DOT number, the registration, or their MC number if they're hauling processed goods of others, interstate commerce. So this is the key here, is that the premium also needs to be considered now for all autos they use, because we have to protect the public. The insurance company has to protect the public for any auto they use, whether owned or not owned. So it's important to verify the units used by the motor carrier. This is how the underwriter established the estimated premium at inception. During the policy term, they also monitor the vehicles the insured uses by the vehicles that are reflected on the roadside inspections or on any kind of reports that are required. And at the end of the policy term, in most cases, the insurance carrier has a right to come and audit those areas of potential premium exposure and make any adjustments in premium after the fact. So the information from the insured shows what vehicles they're owned. The financial statement would be for every vehicle about $200,000 worth of revenue. Then they also have the non-owned, if it's leased or finance company, or if it's owner operator, they'll have to be 1099. We look at the public website Safer to get information. This is provided by the motor carrier to the government on their 150 form, and it must be updated biannually. What the insurance provider typically looks at is for every unit, there's one driver and about 100 to 105,000 miles. That's the premium base they're looking for. It can vary, but that's where they start. If it's less than that, it's probably more favorable, 80, 85,000 miles, because the more miles, the more exposure. More than that, then they have increased potential exposure. But with one truck and one driver, it would be almost impossible to go more than about 120 to 125,000 miles a year. So if you have more miles than that, then you're using team drivers or slip seat drivers. But our whole premium is based on usage, meaning that the exposure is the usage, and that's the more miles per vehicle, the more exposure. The roadside inspections that are done as we look into the Safer and look into the analysis and insurance, the analysis part of the Safer report, the CSA information for most of y'all who are used to that, it shows the unit and the serial number and listed on the inspection. And then what we need to do as an insurance carrier, a review before providing the quotation. Are we addressing all the units that the insured had inspected? And after initial inception, the unit's not on the list or the schedule. Why not? Why aren't they? So now let's go drill down into the symbols. Any auto. When you have the symbol in any auto, There's no problem for the insured. The only consideration if an auto accident happens to have coverage was the damage done by an auto. There's no need to have it listed in the policy, no requirement for the insurance carrier to know about it, because it's only if it's an auto, the only difference will be between auto and mobile equipment, which would be a GL exposure that we're not going to get into in this short session. So the auto means a land motor vehicle, trailer or semi-trailer designed for travel on public roads. There's no wheel requirement. It can be a moped, it could be a private passenger vehicle, it could be a pickup, it could be an 18-wheeler or 17 wheels or more. By the way, the numbers of tires that are here is to meet the state bridge law requirements for weight distribution. And so typically that's a 5,000 pounds per tire. So that's why you see so many tires, not to haul the load, but to meet the state requirements. So when we have any auto, you got to think about, are the insured have potential for using or owning in the insured's legal entity, a moped, a motorcycle, private passenger vehicles, pickup trucks for service purposes, beyond just the 18-wheelers or the 17-wheelers, the true commercial autos. You have to worry about the personal exposure, individual. Private passenger vehicles or motorcycles or etc. You need to work those out. Are they involved in that, and are they being owned by the named insured? Now, the individual use are the ones we're talking about. Other than that, if it's smaller units, how are they used? Is it mechanics pickup truck? Are they doing last mile delivery? Or they have carrier service or not? My strong suggestion for any vehicle that's smaller use, personal use, and even it's owned by the legal entity, you'd want to try to spin those units off to another policy. Much easier to address personal liability vehicle used personally on another policy, Progressive, Allstate, those things. When I had a consulting company, one of my vehicles that I used, the one that I drove, was owned by my consulting company. But I had it insured with my personal auto insurance with a consulting company as additional insured lessor. And so that's how you would do that, and then focus on the coverage we're going to provide on our policies just for the commercial units. There are two elements of things that we cannot properly underwrite. Those two elements are use of personal vehicles personally and uninsured motorists, which is another subject. If we cannot contemplate it or underwrite it properly, then the best solution is to have them insured some other places, like the personal autos that we're talking about here. The word to do this, you can use the CA 9954. This is where you can have designated endorsement. There are a few insurance companies who have also modified their ISO form to include this. If any auto, waiting to meet a filing and MCIEF 90 promise, this is what we want to do. So my suggestion, instead of any auto, which would be symbol 61, any auto 10,000 GVW or larger. That's the commercial vehicles that meets the MCIEF 90 requirements. Or if you have hired auto, be careful about hired auto. Only those autos you lease, hire, rent, or borrow 10,000 GVW or larger. The reason that's important is that if you have an individual on the name insured line, or even if the corporation or the business has a motorcycle or something like this, then that would be under the hired auto exposure if they lease the vehicle personally. For example, if I lease a vehicle for my ski trip and my name insured on the name insured lines an individual, then that's a hired auto or any auto that I'm using, and that auto would have to, the policy with any auto on it would have to respond even for that personal use of the hired auto. So to relieve our problems of any personal vehicle exposure, meaning private passenger vehicles used personally, mopeds, motorcycles, those kind of things, you'd want to have any auto 10,000 GVW or larger. If you write the any auto, or if you write a hired auto separately, only those autos you lease, hire, rent, or borrow 10,001 GVW or larger. That's the consideration you want to have here, again, to get rid of the personal auto exposure. For hire interstate motor carriers, insurance providers typically will not provide any auto. Why? Motor carrier will not tell the truth, too lazy to audit. The example that I use when we do face-to-face classes is the Fort Myers church Example, many years ago, I was on the insurance committee of the First Baptist Church of Fort Myers, Florida. As a part of that responsibility, I put specifications out to have other insurance carriers or agents to quote it. And a part of that, I always ask for any auto on my symbol requirements for autos. I got a quotation that was very favorable, but they came back because favorable for property and other things. But as far as the auto, they came back and said, we're only going to offer specifically described autos. And I looked at the agent and said, okay, I understand that part of it. But before I provide you a quotation or provide this quotation to the Board of Deacons, you need to explain to me why you won't give me any auto. And the only two reasons I can think of, feel free to think of another, is you do not trust the First Baptist Church of Fort Myers, Florida to tell you the truth, and or you're too lazy to audit. Well, I got any auto in about 30 minutes once the agent took that back to their underwriter. But this is why you have a problem with commercial auto and writing trucking accounts, because we cannot trust the motor carrier to tell us about all the autos they're going to use, particularly owner-operators vehicles that can be added to and taken off the policy so quickly. And second, we cannot wait till the end of the year to audit because of the ability to add and take vehicles off during the term of the policy that they don't own, mainly because of owner-operators. So this is why most insurance carriers will not give any auto, is these two factors. How do we monitor all the use of vehicles insured uses, whether they're owned or not owned, mainly owner-operators? And how do we collect the premium on the ongoing basis without waiting for an audit? So there's a difference between owned and non-owned. If it's owned, we typically know about them. Why? They're the ones that are being inspected all the time. It's verification to insurance for other things. If it's purchased or financed, you have to look at the lost payee part of it here. Or when you when they buy a new one, you have that proof of coverage if it's in their name to buy the license plate. And we can look at their financial statements and look at what their own assets and how many equipments they own versus and the appreciation on those equipments for those assets. So owned autos typically are easy to find out about and know about. The ones that are not so easy is to add the ones that can add to the operation. Those are the owner operators, because those could be added without the insurance provider's knowledge, meaning there's no lost payee, there's no need for proof of coverage for a license plate because they're using apportioning tags. And so originally underwriting, you need to look at the public information. That will look at the IFTAs, those are the monthly mileage reports, and you want to look at the inspections. And you want to look at those two things to see if the number of miles they generate, again, about 100 or 105,000 equals a vehicle, and what vehicles are being inspected, and how do we account for those things. So because of owner-operators, this is where it's tough to have any auto, or not easy to have any auto, because of how we want to understand that, particularly when we have the vehicle listing requirements. So during policy term, the real concern would be a reporter that will match the inspection information. So if we have a monthly reporter where we report the vehicle listed, then the inspection information, we will go back again and see what vehicle is being inspected. So the difference between insured, as we consider use of any auto, would be, are they using only owned autos, or are they using owner-operators? If they're using owner-operators, that creates some additional concerns we have to make sure we're getting the premium for the exposure of those vehicles that are used, because of how we monitor those owner-operators' activities. So the underwriting consideration. Trust the insurer to tell you about all the units. Yes, but then we also verify it. We look at SAFER, what they told SAFER, and they look at 105,000, which would be a good assumption for every unit that they might operate if they operate over 300,000 miles. We ask for the IFTA reports, but IFTA reports have two things. They only deal with vehicles across state lines. So if they have intra-state vehicles, meaning vehicles who never cross state lines, then we have to work, those miles are not reported on IFTA. So you have to ask the insured how many vehicles you have that do not require portion tags. Apportion tags are required for any vehicle 26,000 GVW or larger that crosses state lines. And therefore, if they do not have an apportion tag, that miles will not be reported in IFTA. You also need to find out the owner-operator has their own account. Owner-operator can have their own tax reporting account for IFTAs. It's a benefit sometimes to the motor carrier because the way IFTAs work, where depending on the state they buy their fuel in, whether it's a state with a high road tax, state road tax, or a low road tax, what happens at the end of the quarters is that the insured reports, or the IFTA holder reports all miles traveled in all states. And if they buy fuel in a state that has a low tax like South Carolina versus a state that has a higher tax like Georgia, there could be an additional amount due under the IFTA report. And if it's owner-operator that owes that, then how are you going to collect that from the owner-operator if those miles are reported under the motor carrier's IFTA report? So a lot of times the motor carriers protect themselves from the debt that could be obligation because the owner-operator doesn't buy fuel correctly. Then they say, okay, owner-operator, you have your own IFTA account. And then we have a problem as an underwriter to get that information. There is a new thing that we have to consider. That's electronic log devices. Electronic log devices reflect all miles used by a unit, meaning owner-operator or owned. And that would also be at IFTAs. So one way you would maybe not rely today because of new electronic log devices requirements that were effective for all units that have engines in them 2000 or newer, then you want to have access to that electronic log devices mileage there. This would give you a better tracking of the miles the units operate than even the IFTA reports would, because it goes from exact miles, all miles, not just, even with IFTA, sometimes they report it from zip code miles, which could be different than the actual miles. So there is a new factor that we have to consider, and that's the ELDs, which will give a underwriter or give an insurance provider comfort that we are accounting for all the miles. So what we want to look at is auto equals the number of miles, 105,000 equal the premium per mile. This is what we then end up to having back to the premium necessity based on any auto. So let's say one auto, X premium, $6,000. What we'll say for every 105,000 miles, then there will be a $6,000 premium, or close to a 6% rate. This is how we would determine the number of how to get the proper premium for any auto. We can look at the financial statement and look at the income on it, and non-transportation income, which would be brokerage or detentions, those kind of things, fuel surcharges, depending on how they're rated here. Then you look at the transportation only. Again, that's the fuel tax and the waiting time. You have to make adjustments for there. The concern that you have for the financial statement is that the revenue per unit is stable, meaning does it look reasonable? Are we getting 200, 205,000? And that could depend on the business operations that they're having and the time that and what they're hauling. So you'd have to worry about that. There's more problem with revenue based than miles because of the definition of what is revenue. I have found often the insured wants to put in everything they gross, no matter where it comes from, going in to base the premium on. But at audit time, they want to leave all this stuff out that's not transportation, again, like waiting time and fuel taxes. So the concern you would have here is to balance the revenue and miles to make sure they make some sense. But again, revenue dependent premium base is not quite as accurate as miles. For the other thing is that if during the year there's a change in rate per mile that generates revenue, then every time there's fewer rates per mile, we're getting fewer premium per mile because the reduction in the fueling hauling rates, or if the insured is able to get more revenue per mile, then it increases their insurance costs. So there's a lot of volatility on the revenue basis. So most insurance carriers like to use mileage as long as they can account for the intrastate miles and the owner-operator miles on a dependable method. And this is done by monthly reporting. This addresses change in operation during the policy term. Past history for stable growth. That's what we measure here. And we also don't worry about the purchase auto versus owner-operators vehicles because we want to make sure that the all vehicle miles are there. And this is why we talk about is the IFTAs or LD more. So you want to report monitoring, and this should be on a monthly basis. You'll have either miles report, and then you have to decide it's going to be IFTAs, ELD miles. The ELD is a new revelation that I would strongly encourage you to look at to add the ELDs. The limit, it could be a unit reporter where the motor carrier provides us on a monthly basis if they add a unit or remove a unit, and then we make a monthly adjustment. So the 2 points that we're doing here is going back to the example of the First Baptist Church of Fort Myers, Florida. We're monitoring the insured how to tell us the truth. They're looking at and reporting this on a monthly basis, but what they're reporting is the activities of those units, not the units themselves in most cases, or if it's a unit report of the units itself would be reported. But we're using what we have, the known miles, the IFTAs, the LDs, the 150 report to verify that those reports are accurate, coupled with the vehicles are being inspected. And then again, these are audible or not. We're also now collecting it on a monthly basis. And when we collect on a monthly basis, then we make those adjustments during the year, not at the end of the year. So whatever you want to define as covered auto that we're going to be reported, if reported is received timely and accurately, this is the concern you have to make sure we're getting the right premium and we're collecting premium on an ongoing basis. And the key accuracy is something that we need to make sure the insured is honorable enough, stable business, and those reports make sense on an ongoing basis, again, based on what the typical marketplace for a unit traveling in those territories and those radiuses are correct. So if the report during the term in the financial statement, even if premium base is not based on revenue, you'd want to look at the financial statements too to balance the IFTA, the miles per income, and the unit reporter, and then you can use the inspections to verify the unit reporter. In the year audit, what you have is typically a 25% deposit. Why 25% deposit? This on the projected annual premium, because it takes 36 days to cancel a policy that has MCIEF 9 endorsement on it. That's a 25% premium. If you don't get that much up front, then you cannot cancel the policy in time not to have any earn premium part of it. So you want 25% down. That 25% is an escrow account, it's a deposit. You agents, you do not get a commission on this, and it gets returned after 12 months are reported. What happens a lot of times is that you get to the end of the reporting provision and you have this deposit out there. A lot of times the insurer says, okay, we don't pay the last 2 months of report because we have that deposit. Well, that's not a good practice here. That creates a lot of problems. They need to pay the whole thing, and then at the end of adjustment, they will get the 25% deposit back or carry it over to new term. The only time that you would have this last one or more incentive if the insurer does not intend to renew with you, and you'll find out when they don't pay the premium connected to the last couple months of report. When your premium comes in, you need to look at it. Typically, they're due 10 days after the end of every month, and you will look at it to see if it makes some sense. And so what you also have to worry about is the minimum earned premium. Typically, there's 80 to 90% minimum earned. That's based on the number of units and stability of the risk. There could be some variance during change of business, during the business environment, where you could have more miles that you would have that would not problem from for them meet the minimum. But if you have fewer miles because of the economic downturn, because of pandemic like happened recently, and or downturn in the marketplace where the units are not, the insurers can't not use units, then you need to adjust this annual minimum during the policy term. So you need to also look at that. So you need to look at it on a monthly basis to worry about that. There could be a monthly payment due. I don't like a monthly earned because it should be adjusted at the end of the policy year. You could be a monthly payment just to get a level payment from the insurance carrier, then you make the annual adjustment. But one of the problems that you have with a reporter is, how does this 25% down? It's not commission. How is that secured? It's cash the insurance company holds, and it should be, and it's only returned after we have the 12-month reporter and do the end of the year audit. You have to worry about the minimum premiums to protect the insurance companies for estimating going in with too low of a rate and not meeting those annual mileage that we projected here. And so you want to monitor those things during the policy term to make sure the insurer's business environment has not changed, particularly where there's a downturn in their business that we might need to adjust those minimum earned during the policy term. You cannot wait until the end of the year to do that. And lastly, you want to look at the monthly. A lot of premiums, there is a monthly premium minimum, but you do not, in my opinion, want to have that a monthly earned minimum. You want to have a monthly premium payment to get some kind of level of income by the insurance carrier, but you want to then be able to adjust this on an annual basis. So any auto, symbol 1, 61. That includes private passenger mopeds, motorcycle, and those things. So suggestion would be any auto 10,000 GV, they'll be larger. That would be symbol 71 using CA 9954. The premium base, you want a monthly reporter. That gets back to how the vehicle is being used, and that's the better and fair measure to do this. So you collect the premium from the exposure on a monthly basis. That's the usage. You want to have the base of the mileage. That would be the IFTAs, or now preferably the electronic log devices, or revenue. You want to have those premium bases defined, meaning not only the IFTAs and ADLs, but also make adjustment for intra. And if you use International Fuel Tax Agreement, IFTA, then you want to make sure that you are including owner-operators. Coverage provided based on the number of reported units. Monthly reported for policy changes in the units. The insured provides a list monthly. They'll take add or remove. These would be owner-operators or independent contractors would be the ones that will be taken off and added mainly, would be the owner-operators or independent contractors units. So that tells you the problems with and how to look at any auto symbols. I hope these suggestions will give you a better understanding of not only why the insurance carriers who write motor carriers are reluctant to provide any auto, but how to get any auto being written, and then how, once it's written, how to make sure that the insured and the insurance company are getting a fair premium for the activities of the vehicles. We hope you benefited from this. We look forward to you participating in other programs of the Motor Carriers Insurance Education Foundation.